Hi, everyone. Before we begin, I would like to remind everyone to submit your questions via the Q&A pane. You can upvote questions by hitting the thumbs up button underneath each question, and we'll address as many possible questions that we can at the end of the presentation. Firstly, the University of Queensland acknowledges the traditional owners and their custodian of the lands on which we meet. We pay our respects to their ancestors and their descendants who continue cultural and spiritual connections to country. We recognize their valuable contributions to Australian and global society. So good afternoon, everyone, once again. For those who don't know me, my name is Janita Jung. I am the lead of the Young Professionals portfolio on the UQ Young Alumni Board. For work, I serve as the Group Marketing and Technology Manager at Risk2 Solution Group. It's an absolute pleasure to be here with you all this afternoon, and I'm thrilled to see such a fantastic turnout. Our mission on the UQ Young Alumni Board is to support and empower young professionals like yourselves, providing valuable insights and practical knowledge to help you thrive in your careers and personal lives. As part of our commitment, we're excited to bring you a series of events that go beyond the paycheck. So today's event is just one of the many where we aim to provide actionable advice and expert guidance on various aspects of professional and personal development. Now let's get to the main event. I'm honored to introduce our speaker for this afternoon, Claire Green. Claire is a mortgage broker at Fourfold Mortgage Consulting and a proud UQ alumna, having graduated with a Bachelor of Business Management in 2001. Claire brings a wealth of experience in the mortgage industry, and this afternoon she'll be sharing her insights and expertise on the home buying process. So please join me in welcoming Claire Green.
Well, hi everyone. Welcome to Beyond the Paycheck, Home Buying 101. Thanks so much for the introduction, Janita. I'm very excited to speak with you all about a topic of interest for many people, and I hope that you all learn something today and that this information may help you when you're ready to purchase your own home. Before we get started, just to reiterate that the disclaimer that was just popped up on the screen before. So what I'm presenting today is general advice only. And if you have any questions or would like specific advice on your own financial situation, please feel free to get in touch with me and I'll have my contact details available at the end of the webinar. So as Janita mentioned, I work as a mortgage broker with Fourfold Mortgage Consulting, and we are in Brisbane. We are based north side with our offices in the beautiful Ascot suburb. We are a boutique mortgage broking business, and we work with a really diverse range of clients, all the way from first home buyers to highly experienced property investors. We work with our clients to find the best loan solutions for them, and this may be to buy a home, it may be to fund a renovation, it could be to build a home, or it may be someone looking to refinance their existing home loans. So in terms of this webinar, I have split the topics up into four main areas to work through. The first being home loan basics. The second one is key terms. Then we're going to chat through borrowing capacity and finally understanding the home loan process. I'm very happy to answer any questions that I can after each topic. But if they are specific questions or we run out of time, you are very welcome to email me. So let's get started. So the first topic here is home loan basics. I just wanted to run through a few of the more basic home loan concepts before we sort of get a little bit more detailed later on. So what is a home loan? Well, a home loan is a type of loan provided by a bank or other lender to finance the purchase of a property. Sometimes a home loan is called a mortgage, and these terms do tend to get used interchangeably. However, technically they are not the same thing. A mortgage is a security interest that the lender takes over the property to ensure that the loan is repaid. And the term security interest here just means the legal right that a lender has over the property being purchased. And it basically means that if the borrower fails to repay the loan, the lender has the right to sell the borrower's property. So the home loan is the actual financial product that is used to buy the property, while the mortgage is the legal agreement that gives the lender security over the property being purchased. So let's look at how a home loan works. When you borrow funds, you then repay this amount according to a loan repayment schedule, and the lender charges you interest. So in a bit more detail, you have the loan principal. So you borrow funds from the lender, which become the loan principal. You have the interest rate. So the lender charges you interest on the borrowed amount. The interest rate determines how much you'll pay over time. There are two interest rate types here. So we've got fixed rates, which lock in a specific rate for 1 to 5 years, ensuring stable repayments. Now, this option may suit borrowers who want greater certainty over their regular repayments. And then we have variable interest rates, and these rates can change anytime. They generally move when the Reserve Bank moves the cash rate. And then if the interest rate does go up, so do your repayments. So this option can offer a bit more flexibility, including features like extra repayments and offset accounts. We then have the deposit. So you typically do need a deposit to purchase a home. And finally, we have loan terms. So most Australian home loans have a term of 30 years. So there's a basic overview of how a home loan works. Another term you may hear a lot about when it comes to home loans is pre-approval. So pre-approval, which is also known as conditional approval, sometimes also approval in principle, is when a lender agrees in principle to provide you with a home loan up to a certain borrowing limit. And this step happens before you've found a property, and it may give you some comfort over how much you can borrow. Once you've found a home and signed a contract, then some further checks will be required by the lender to get formal approval on your home loan. Another topic area that we get lots of questions around is self-employment and people wondering if they can get a loan if they are self-employed. So the short answer here is yes, you can get a home loan if you are self-employed. So when you are self-employed, you may have to provide some additional detail around your financial situation, and the lending criteria can be a little different from salary earners, but there are plenty of options for self-employed business owners. And the other good news is that you won't be put on a higher interest rate just because you're self-employed. Your loan comes with the same rates, features, and benefits as salary earners. In terms of business trading and how long you may need to trade before applying for a home loan, well, most lenders do like to see about 2 years of trading history before they will lend to you. However, some lenders may consider less than this in certain situations. So it is definitely worth having a chat with your broker if you're in this situation and would like to know more. The last topic area I'm going to cover off here is also very commonly asked, and it is, are there any first home buyer grants or other assistance or concessions available to me? So this is quite specific to your own personal situation, but there are a number of grants and concessions available for those who do qualify for them. Today I won't be able to touch on them all, but a short summary of some that may be of interest, and you can then look into them further if they sound like they might be relevant. So firstly, the first homeowners grant. I'm looking at the Queensland grant here, as this is state-based. There are quite a few conditions on this grant, but I think two of the most important ones when you're looking at relevance to you and your purchase are that firstly, the purchase must be a new home, so it cannot be an established or existing home or residence. And then secondly, the value of this new home must be less than $750,000, which includes the land value. So it's quite specific grant here for new homes only. The first home buyer guarantee is the next one we'll look at. This is an Australian government guarantee up to 15% of first home buyers' purchases, which to try and help them avoid mortgage insurance. The guarantee is not a cash payment or a deposit for your home loan. It just means that you may be able to purchase a home loan when you've got a smaller deposit without having to pay mortgage insurance. And we'll touch a bit further on mortgage insurance a bit later on in the presentation. State-based limits here apply on purchase price as well as income caps. Next, we'll look at the First Home Super Saver Scheme. So this is a scheme which allows you to make personal voluntary contributions into your super fund to help you save for your first home. as well as helping you save your deposit, these contributions may also have some potential tax benefits. So you can contribute up to $15,000 a year into your super to use in this scheme. And this is a per person limit. And then you can withdraw up to a total of $50,000 per person to use to purchase your first home. So my thoughts here would you do need to plan well in advance to use this scheme, given that the maximum contributions are only $15,000 a year. And also, given the maximum withdrawal is $50,000, it realistically will only cover part of a house deposit. And finally, stamp duty concessions. So there are a number of states offering stamp duty concessions for first home buyers, and these vary again between states. But for Queensland, first home buyers are currently receiving concessions on transfer duties for properties valued under $800,000. So stamp duty is also known as transfer duty, and it is a state-based tax paid for stamping of legal documents. The amount varies according to the amount you borrow and your purchase price. And it can be a significant cost. So it's really important to understand how much it may cost you and to make sure you budget for it. So that's it, a very brief summary of a few of the grants and concessions that are currently available for home buyers. And that's the end of the first topic. Do we have any questions at all, Janita?
Thank you so much for that insightful presentation, Claire. We've received some fantastic pre-submitted questions from the audience, actually. So let's dive into some of those pre-submitted questions from our audience today. And as a reminder to everyone, please submit questions through the Q&A pane so that we can help answer your questions throughout today's session as well. So our audience is curious about pre-approvals. Is it necessary to get pre-approval, and does having pre-approval guarantee that they will secure a loan?
Thanks, Janita. That's a great question. We get asked a lot about pre-approvals, and it is definitely not a requirement for borrowers to get pre-approval. But there are some obvious advantages to getting pre-approval. So I think firstly, pre-approval lets you work out how much you're able to borrow. So this may be really useful when you're house hunting, because it gives you that really upper concrete budget limit. You know exactly what your maximum purchase price is and what you can afford. And then following on from that, if you're bidding at an auction, it may give you some confidence. You know, you have a very clear idea of what you can bid up to and what you can borrow, what you can't go over. So I think that's really important. And then I think finally, the other real benefit of being pre-approved is that it can help speed up the approval process when you need to move to formal approval. And it may just take a little bit of stress off, quite a stressful time when you're trying to purchase a property, because, you know, most of the work has already been done for you at that point. And then to just the second bit of your question, am I guaranteed a home loan if I have pre-approval? Well, the short answer is no. It does not guarantee you loan approval. It's basically just an indication of your potential borrowing power, and you will have to resubmit your application with updated details once you find a property. But realistically, it's a very good indication of your borrowing power. And, you know, unless you were very close to your maximum capacity, or your circumstances significantly change, or interest rates move, then it is very likely that you would be able to get your home loan approved and move to formal approval.
Thanks, Claire. We also have a question from an Australian residing overseas. Can they still obtain a home loan while living abroad?
Thanks, Janita. Yes, the answer here is yes. Australian expats can absolutely both purchase property, Australian property, and apply for a home loan while living and working overseas and earning foreign income. So lenders may assess things slightly differently from people living in Australia. For example, your foreign income may be assessed differently from income earned in Australian dollars. An example of this is that the lender may do what we call shade your foreign income, meaning we may only be able to use 80% of your income towards your borrowing capacity instead of the usual 100%. So your borrowing power just may be a little lower than if you were earning the same dollars in Australia. And the other thing that I can think of that may be impacted is your any tax deductibility of any rental income that you may have, which again would just impact your borrowing power. So that's what I can think of in terms of getting a loan if you live overseas.
Wonderful. Thank you so much for that, Claire. I see there are some questions coming through, which is great. We might just move on to the other section of the presentation and address some of those that are coming through live at the end. So Claire, back to you.
Sounds great. So the next topic area we're going to run through is key terms. So I've put together a list of some of the key terms that I think that you should realistically know if you're looking at buying a property. So let's start with interest only. This is a term to do with interest repayments. So if you choose interest only repayments, it means that for a set period of time, no principal will be repaid off your loan, just interest charges. So interest only repayment terms range between 1 and 5 years. And then at the end of this, your loan will automatically switch to a principal and interest repayments for the remainder of the loan. And your repayments will be higher from this point on. So let's compare this to a principal and interest loan. A home loan with repayments of both principal and interest is one in which you pay interest and also repay part of the borrowed amount or the principal at the same time. So one of the benefits of selecting a principal and interest home loan from the beginning is that your repayments will be lower over the life of the loan, since each time you pay the minimum repayment, you're chipping away at the principal as well. So just thought I'd run through a quick example here because that may make it a bit easier to understand. So you want to borrow $400,000 P&I over 30 years with an interest rate of 6%. Well, your monthly repayment here is $2,398. You can use a repayment calculator to calculate what your monthly repayments would be. All of the major lenders have one of these up on their websites. So if you had elected instead for a 5-year interest only period on the same 6% interest rate and the same borrowing amount, $400,000, your repayments would instead look like this. You would pay $2,000 for the first 5 years, and then you would pay $2,577 for the remaining 25 years. So this, you can see here the difference in how the two repayment types work. So a couple of quick notes on this, that interest only loans are generally used for investment properties and not for owner occupiers. And interest rates are generally higher for an interest only loan than a P&I loan. So LVR, or loan to value ratio, is another important term. And LVR is a key lending calculation actually, which shows the ratio of the value of your property to the size of your loan as a percentage. And banks commonly use LVR to assess the risk of the loan, with a higher LVR representing a higher risk to the lender. So here's a quick example again. So John here wants to buy a property with a bank valuation of $500,000 and it has a deposit of $100,000, so needs to borrow $400,000. So here's how the calculation works to get LVR. So your loan amount divided by your property value equals your LVR. So 400,000 divided by 500,000 to get 0.8 as a percentage. So your LVR here is 80%. I just thought this was quite interesting. A quick note on how the property valuation part works. So we use the bank valuation here in an LVR calculation, which may not be the same as market value. So a bank valuation is a property valuation performed by a professional valuer, and it may be different from the estimated market value provided by a real estate agent, because the bank has to ensure that they don't lend more than the property's true value. So now that we know how to calculate LVR, having an LVR of 80% or lower may help you borrow at lower interest rates with lower repayments. So if you have an LVR of more than 80%, you may need to pay what's known as lender's mortgage insurance, or LMI. So let's have a look at what that is. So lender's mortgage insurance protects the lender if the borrower can't meet their loan repayments. And if this happens, the property securing the loan will need to be sold so that the bank can recover the debt. But sometimes the sale price of the property isn't enough to pay back what's owed, which is where LMI comes in and it covers the difference. It's important to understand here that LMI is obtained by and insures the lender and not you. It's calculated as a percentage of the loan amount, and in many cases you can add it to the amount you borrow, so you don't need to pay it up front. And sometimes lenders have special offers that waive some or all of the mortgage insurance up to specific LVRs, or sometimes for specific professions. So it is worth having a chat with your broker about your specific circumstances on this one. A family security guarantee is another interesting one, and I thought it was worth running through. So if you are struggling to save for a deposit and want to avoid paying mortgage insurance, then a family security guarantee could be an option if if one of your family members can help. This allows a member of your family, usually parents, to act as a guarantor on your loan, using the equity in their home to help you avoid the LMI. So I just thought I'd run through a quick example of how this works, or how it works basically. So imagine you want to borrow $440,000 for a property valued at $500,000. So doing our LVR calculation, that's an LVR of 88%. With an LVR of 88%, LMI is applicable, which is an added cost. However, if you make use of the family security guarantee and your guarantor agrees to provide $50,000 as additional security, the LVR on your loan does reduce. So having a look at scenario 2 then. So your new calculation, including the family security guarantee amount, makes your LVR 80%. And with the new LVR, LMI is no longer required, which can be a really significant saving. So this can be a bit complicated. So it is worth speaking with your broker about it if you would like to explore this option further. But I thought it was worth mentioning in the presentation. All right, now we have a few more interesting terms here. We've got offset account. I'm sure you've all heard of that. So let's have a look at what it is. So an offset account is a transaction account linked to your home loan. So money that you put in your offset account acts the same way as if it was in your mortgage account. It offsets the balance of your loan on which interest is calculated. So it helps reduce your interest payments, which may help you pay off your loan sooner. A quick example here again. So if you have a $400,000 home loan and an offset account with $50,000 balance in it, you'll only be charged interest on $350,000 of your home loan balance. You may also heard of a redraw account, and I thought I'd touch on this and just let you know that it is not exactly the same as an offset account, but they do work in a really similar way. Redraw funds are a little bit harder to access perhaps than funds in an offset account, but the funds do still work to reduce the interest amount that you pay on your home loan. Finance clause is another common key term, and this is a term you will often see in your home buying contract. A subject to finance clause gives you the option of terminating your contract and getting your deposit back if you can't get a home loan approved. So this can be a lifesaver if you're buying a home and your finance does actually fall through. A finance clause typically gives you 14 days to secure finance, but it can be as much as 21 or as little as 10. But we do recommend that you try to negotiate a minimum of 14 days because it just gives you enough time without the huge added stress of time pressure to get that formal finance approval through. And the last term I wanted to touch on here was credit file. So a credit file is a summary of your credit history, and it includes details about the types of credit accounts you've had, your payment history, and other relevant information like credit limits. And these files are maintained by specialist reporting agencies such as Equifax. You may have heard of them. And when you apply for a loan, with your approval, the lender and sometimes the broker will run a credit inquiry. Lenders use this information from your credit file to evaluate your credit risk when deciding whether or not to approve you for a home loan. And that's the last of the key terms there. So ready to move to some questions if there is any.
Yes, there are, Claire. Thank you so much for that.
It's okay.
On credit scores,
Yeah.
what are some of the best strategies young professionals can use to improve their credit scores? I'd love to know.
Thanks, Janita. Okay, I can think of a few ways you could try and improve your credit score. So I think the first one and the most important one is to make sure you pay any existing loans and debts on time, because a consistent record of on-time payments is really key in a strong credit score. Perhaps an easy way to make sure that this is easy for some people, to make sure you're not getting any defaults on there, is to just set up automatic payments for all of those type of credit card bills and that type of payment, so that it just gets taken straight out of and you're not missing any. I think the second one would be to just when you're applying for new credit, just think carefully about any new applications that you're making, because any application you make for credit does show up on your history, especially if you're sort of making a lot of applications in a short space of time. It may have a negative impact on your credit score. And then finally, you don't have to have a credit card to establish a credit history, but if you do have a credit card and can manage the payments and pay it off each month, this can help you demonstrate that a positive repayment history, and it can help improve your credit score as well. So I think they would be the main tips I can think of there.
Yeah, great to know. Thank you so much for that, Claire. We also have an audience member who is interested in reducing their loan to value ratio, the LVRL.
Yeah.
Is that right? LVR, that's right.
Yeah.
How can they achieve this, and in what ways can their parents assist here?
Okay, so I think a couple of ways to reduce your LVR would be, I guess, firstly, build your deposit. So just continue saving as much as you can until you have a bigger deposit, hold off buying the property, and your LVR would be lowered that way. And another way would be to maybe adjust your property search and buy a less expensive home. Maybe that's you can still get into the real estate market this way if that's something really important, but you would be able to have a lower LVR that way. And in terms of parents helping out, well, I think absolutely. I think that there's the family guarantee that we discussed before. That's definitely one way. And another way, if they would be feeling very generous, would be to gift you some deposit funds, as most lenders would accept this as part of your deposit.
Great. Thank you so much for that, Claire. We'll move on to servicing the loan section, but we have some great questions coming through, so can't wait to get to some of these questions towards the end.
Perfect. Okay, so the third topic area is borrowing capacity. So it's also sometimes called servicing. And this will answer your questions around how the lender calculates how much you can borrow, which is obviously quite important for any home buyer. So your borrowing capacity, or the amount you can service, is the maximum amount that you can borrow from a lender and still meet all of your loan repayments. So just to make this a little bit more confusing, all lenders have different policies for calculating this number. So this means that you'll be able to borrow different amounts using the same inputs depending on the specific policies of each lender. So for the purposes of explaining the inputs here, I will be using some generalizations. So to calculate your borrowing capacity, we need to know your income, expenses, and debt liabilities. So let's go through all of these in a little bit more detail. So firstly, income. We need to know your income from all sources. So some examples of different income types may be PAYG income. So for many, this is maybe as simple as your salary. You may work full-time, part-time, casually, or in a contract position. Secondly, we have bonuses, commissions, allowances, and overtime. And we can use these additional types of income most of the time, though all of the lenders have slightly different rules on this. Generally, though, the income is shaded. and the lender allows a percentage to be used towards your servicing. So for example, if you have a bonus of $20,000, the lender may shade this to 80% and allow you to use $16,000 of this towards your servicing calculation. Self-employed income there. So for self-employed income, we would generally look at the net profit of the business. The calculations are a bit more complicated than this with add backs and non-recurring income and expenses, but net profit is a good place to start here. And other income such as rental property income and dividend income can also be used and is again shaded as per lender policy. So the next category here is expenses. And the servicing calculators generally break these down into a couple of general categories. So the first one is general living expenses. So for example, here you can see we've got medical and health there, we've got groceries, clothing and personal care, recreation and entertainment, childcare, telephone, internet, media, transport, education costs, not including HECS there, or private school fees. We've got general insurance and primary residence costs. And then the second category there is additional living expenses. So some examples there are personal insurances like health insurance, accident insurance, life insurance. We've got private school fees. We've got owner-occupied strata and body corporate. We've got secondary residence costs and other living expenses. So there's lots of categories there, and we just look at what your general monthly expenditure is on each of those. And the third category is debt liabilities and other commitments. So this section includes credit card limits and buy now, pay later cards. It may also include other loans such as car loans or other personal loans and your HECS debt. So most of the time lenders use the loan repayments that you make in their calculations. However, credit cards are assessed a little bit differently, and it's the whole limit of your credit card that is assessed, not your balance or spending. So for example, if you have a credit limit of $10,000 and a balance of $1,000, we have to use the $10,000 limit in the calculation. So that is a bit of a rundown in servicing. And let's move to any questions on that one.
Great, thanks so much, Claire. So our first question in this section is about HECS debt.
Mm-hmm.
How does having a HECS debt impact on individuals' borrowing capacity?
That sounds like a very important one. And so HECS debt obviously does absolutely impact your borrowing capacity. So the servicing calculators do use the ATO compulsory repayment thresholds to calculate your repayments based on how much you earn. So here it is your monthly repayments that you make that are important rather than your actual level of outstanding debt there. So that's how your HECS impacts your borrowing capacity.
Okay. Thank you. And can you explain how factors like credit card limits affects borrowing capacity and what steps one can take to maximize the amount they can borrow?
Absolutely. So, if you have unused credit card limits, then you can absolutely increase your borrowing capacity by reducing those. So we utilize the credit card limit rather than your actual spending. So basically, they won't ask you what you actually spend on your credit card each month. It will be, well, what is your actual credit card limit? So you can absolutely increase your borrowing capacity by reducing credit limits there. And a few other ways maybe to reduce your, to borrow more, I guess, is to have a look, maybe, is there another way to earn income? Can you boost your earning capacity through overtime or maybe a second role or something like that? You can also look at maybe reducing your living expenses. However, lenders do have a minimum threshold there. So if they think what you're saying is too low, they will just use what they think there. And I guess any other debt that you have, like car loans or personal loans, if you're able to pay them off, then that would, again, boost your borrowing capacity there.
Thanks so much for that, Claire. And thanks so much for that insightful presentation as well. I believe that brings us to an end of the presentation side of things. Is that right, Claire?
I'm just going to run you quickly through the home loan process, if that's okay.
Oh, fantastic. Yes.
Yeah. All right. So yeah, just to tie it all together. So I just thought I'd run quickly through the process to getting a home loan, because it can be a bit complicated even if you've done it before. So here are the most common steps from application all the way through to settlement. So firstly, figure out what you can afford. So this might involve using an online calculator. You can speak directly with a lender if you have a specific lender in mind, or you may choose to speak with a mortgage broker. When working out what you can afford, just remember that there may be other upfront costs to consider. So we've touched on potential additional costs of LMI, but there may also be other costs. Well, there will also be other costs such as stamp duty, lender fees, loan application fees, solicitor fees, just to name a few. So these costs are based on your situation. Best to speak with your lender or broker to get a bit of an accurate picture about how that might look. And then the second step would be start choosing a lender and get pre-approved for a loan. So as I mentioned before, pre-approval is absolutely optional, but it can help you understand what you can afford. And if you do choose to get pre-approval, they generally last for about 90 days. In terms of choosing a lender, there are many to choose from. And when we're helping clients choose a lender, this is what we look for. So we look at policy. So is there a specific policy that you require to be eligible for a home loan? And this may point you towards a specific lender with that sort of policy. We look at, secondly, pricing. So which lenders that suit my requirements have the best pricing. We look at process. So am I under time pressure for settlement? Do I need to use a lender with a fast approval process? And we look at product features. So am I after a specific loan feature, and which lenders might offer these? So the third step would be find your property and put in an offer. So once you find the right property, you can use your contract of sale to negotiate your offer. And once it's accepted, both you and the seller sign this contract, which confirms selling price, settlement terms, and other conditions for sale. Once that is all signed off, you can apply for formal home loan approval. So some documents that you may need to get in order here would be personal identification. So all lenders will require you to verify your identity. Income details, so for example, pay slips if you're PAYG, tax returns if you're self-employed, rental statements for rental income. We need asset statements such as bank balances, credit card statements. We need HEX balances, personal loan statements, that type of thing. And finally, we would need to see a signed contract of sale. So the last step there would be to settle and move in. So a settlement is when the purchase is all completed and it officially becomes yours. The lender will arrange a settlement date, time and location with your solicitor and conveyancer, and that's it. You've bought a home. So I just wanted to let you know what I do as a mortgage broker and what we do and how a mortgage broker can help. So we're basically the middleman who deals with the banks and other lenders to arrange your home loan. We work with you to understand your situation and goals, work out what you can afford to borrow, find some loan options as we discussed before, and we basically apply for the loan and manage the process with you all the way through to settlement. And I think that's really important, that last point, for anyone who hasn't used a broker before, because getting a home loan can be really a bit administrative, and there's a whole lot of documents to submit and sign. And we basically manage this process for you to make it as easy as possible. In terms of who can use a broker, we work with clients from all over. So no matter where you are in Australia, whether you're interstate or overseas, we can help you. And we can help you if you're buying a new property, but we also help clients to refinance their home loans. So how does a refinance work? If you already have a home loan and you've been with them for a long time, then you may no longer be getting the best deal. And this is where a broker can be useful, as we can check your current interest rates against what the rest of the market is offering. And if you decide there's a better option, we can help you refinance your loan. And refinance basically is moving from one lender to another, usually with a different rate or term or features. And once the new loan is approved, you transfer your debt over to the new loan on those newly agreed rates, features and terms. And while it can seem like a lot of hassle to move lenders, a broker, as we said, does do a lot of the legwork for you. So sometimes it just needs a quick chat and we can do the rest. And in case you didn't know, you can use a broker to refinance your home loan, even if they didn't help you get that loan in the first place. Important to mention here that refinancing can come with some costs associated. So you do need to weigh up whether the costs, you need to weigh up the costs with your potential savings to decide whether refinancing is a good idea. And then I guess the most important question, so when it comes to using a broker, how much does it cost? And the good news here is that most of the time it costs you nothing, and it certainly costs you nothing to come and have a chat with us to see if we can help you. So generally, the lenders we use pay us a fee or commission when your loan settles. So you don't pay us, you don't pay the broker anything. So if you wanted to chat through any specific scenarios, my contact details are here. And I think they'll also be sent out post-webinar. So I would be happy to have a chat with you if you wanted to reach out.
Thank you, Claire, for that incredibly informative presentation. I am looking at the time at the moment, so if any of you do need to log off and have a strict sort of time ending, feel free to log off, and we will send around the recording to all of our registrants as well before we get to the Q&A. So please and thank you for joining us today if you do need to leave. But the process of buying a home can often seem very daunting, so especially for us young professionals. So thank you so much, Claire, for navigating some of those complexities with the real estate market for the first time. So really appreciate your time, and really does help empower us to make these informed decisions when it comes to purchasing a property. So thank you. But without further ado, let's dive into some of the Q&A. We've received some great questions from the audience. Claire, one of our first questions is about stamp duty.
Yeah.
Where can someone find out how much their stamp duty will be? And are there public calculators available to use?
Yeah, absolutely. So pretty much all the lenders will have a stamp duty calculator. If you do a Google search, you'll find many. Just make sure, I think, that you input correctly the state you're in, because it does vary by state. So just make sure your inputs are all correct, and you get a pretty accurate guide of how much you're going to have to pay.
Right. Our next question, and I love this question, it touches on a common dilemma for prospective home buyers. What holds more weight when purchasing a property, the available deposit or income? Essentially, should more effort be put into saving for a deposit or demonstrating a good income? I think we understand both are important, but which one tends to be more critical from a lender's perspective?
Well, I guess they're both really different, because the deposit comes into play realistically just for your LVR. So if you have, so that's where that one fits, and then your income determines how much you can borrow. So they're just quite different. Different inputs there. So I guess on the deposit side, if you have the more deposit you have, the lower your LVR, which, we know if we're under 80%, that's great because we don't pay LMI. In terms of having a bigger deposit than that, that's the only thing I guess that helps with is obviously you pay less, you need a smaller loan, but it also does help with interest rates. So the lower the LVR, often the lower the interest rate. So that can be a benefit on the deposit side. And I guess, and then on the other opposite, the income side. So I guess the more income you have, the more you can borrow. So the bigger the loan you can get. So I guess they're just two quite separate things.
No, understood. And while we're mentioning LVRs, we did have a question as well, which I think you answered with saying a lower LVR means a lower interest rate. Does your LVR affect only how much you can borrow, or can it also affect your interest rate? Was the question.
Yeah. So yes, it can. So some lenders don't, but some lenders do have lower interest rates if you have a lower LVR, because I guess you're they are seeing the risk to them as lower. So yeah.
All right. We also have a question regarding the First Home Super Saver FHSS scheme. If you're looking to implement schemes such as the FHSS, would you recommend increasing the duration of the finance clause beyond 14 days? It's very specific.
Oh, that's a good question. Look, 14 days, we can generally get things done. So we generally say 14 days, but yes, if you do have any really scenarios which may need a bit more time, absolutely, if you can negotiate an additional time on your finance clause. How it does work is, if we do need more time, we are generally able to negotiate an extension on the finance clause. So that's how we generally play it, if that's how it works out, and generally the property sellers come to the party on that, and we're able to negotiate that. But sure, if there's any, if you do have any specific tricky situations, then an extended finance clause is never going to be harmful.
Great, thanks for that, Claire. Someone in the audience is also curious about offset accounts. So jumping over to that, are there any drawbacks to having an offset account?
So I think the biggest drawback would be that you pay for them. So you generally pay an annual or monthly fee to have an offset account. So that would be the biggest drawback, I think. Other than that, I can't think that maybe if you didn't require one and you had to pay the fee away, I think that would be the biggest drawback of an offset account.
Great, thanks for that. And our final question for this session is about choosing between banks and mortgage brokers. So maybe could you explain the pros and cons of going to a bank directly versus working with a mortgage broker like yourself?
Sure. So absolutely, you can go directly to banks. That's fine. That's easy. I guess the benefit in going to a broker is that we work across all of them. So we have access to all the rates. We tend to negotiate rates with them because we have specialist contacts in all the lenders we work with. I guess just as an example, I had a client the other day who had gotten pre-approval for their loan with a specific lender, and then by the time it came time to go through to formal approval, there was another lender with a better rate. So we chatted it through and they decided that they would want to go with the better interest rate, which was great. And then we ultimately went back to the original lender who they got pre-approval for and managed to negotiate the rate down there. So I guess that's just a bit of a benefit of working with a broker, I think, is our relationships with a lot of the lenders. We kind of know where their rates sit and how far we can push them down if we have to. But you can do either. We also take a lot of the admin away if you come through us. When you're working directly with the lenders yourself, you'll have to do that yourself. But absolutely, you can do either.
Great. Thanks so much for that, Claire. If anyone has more questions or needs further clarification or anything, please feel free to reach out after the session as well. But thank you so much, Claire, for that incredibly informative presentation and helping and answering all of our great questions that were submitted. I'm sure everyone here has gained some very valuable insights into the home buying process. So thank you so much for your time today.
Thank you.
Before we conclude, I'd like to take a moment to highlight some of our upcoming events in our Beyond the Paycheck series. Next up, we have expert tips to save money when traveling. So join the Flight Centre Travel Group for a webinar dedicated to helping you make the most of your travel budget. That'll be on Tuesday, the 16th of July from 12 to 12:45. And then we have Smart Money Strategies. So whether you're new to budgeting or looking to refine your skills, we'll be joining Courtney Crawford, financial planner at Financial Aspirations. as she provides some tools and insights to take control of your finances. And that'll be on Thursday, the 1st of August, 6:30 to 7:15 p.m. Thank you all for joining us this afternoon for Beyond the Paycheck Home Buying 101. I hope you found the session as insightful and engaging as I did. A big thank you to Claire Green for her fantastic presentation and for sharing her expertise with us. Thanks also to the UQ Young Alumni Board and our dedicated team for organizing this event. So as we continue to bring you all of this valuable content and opportunities for growth, we do encourage you to stay connected with us, share your feedback, and please participate in our upcoming events. Would love to hear your thoughts and discuss any ideas you have for future events. Thank you again and have a wonderful afternoon.